Hi, it's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Change is inevitable. When those changes involve tax law, it is extremely important for clients to meet with their financial professional, tax advisor, and legal advisor to discuss any adjustments that may be needed to be made to their financial, retirement, or estate plan. One change that is looming is the expiration of provisions that were passed under the Tax Cuts and Jobs Act of 2017, which I'll refer to as the TCJA. Many of the provisions for individuals, including the higher estate tax exemption and lower individual income tax brackets, were temporary and will expire or sunset on December 31st, 2025, without further congressional action. My guests today are here to discuss the TCJA. They are two members of the MassMutual team. Lina Storm is the Advanced Sales and Sales Enablement Marketing Director dedicated to MassMutual's strategic distribution team, and Kathryn Wakefield is Director of Advanced Sales at MassMutual. Lina and Kathryn, before we dive into today's topic, please tell me a little bit more about your career path and what led you to your roles now at MassMutual. Lina, why don't we start with you?
Sure, Bob. Thanks. Well, I've been in advanced sales industry for about 20 years, 15 years at John Hancock prior to coming to MassMutual in the last 2.5 years. I've written and spoken extensively on planning strategies, utilizing life insurance and annuities, and I've built software around it. And so my experience has been, actually the trajectory of my experience has been in really different ways to help clients with their financial planning.
Wonderful. And Kathryn?
Thank you so much, Bob. I started as a financial advisor, actually, like so many of you on the call. And a couple of years in, realized that I really loved the planning aspect more than I loved the selling aspect. So off to law school I went, and then from law school, which ended up being about 2 miles away from MassMutual's home office, it was a natural progression to go to work at MassMutual and combine my financial advisory background with my law degree in estate planning. And I ended up working in advanced sales. I've been in advanced sales now since 2010, with a small break to go try out private practice and realized that advanced sales was for me. So here I am.
Well, wonderful. So I'm going to start off with Lina. And Lina, share what will happen when the TCJA, the 2017 legislation, sunsets in 2025.
Sure, I'd be happy to, Bob. So first, more individuals may be subject to estate tax if the estate tax exemption sunsets to the pre-TCJA amount. So the gift, estate, and generation skipping tax, or the GST exclusion amounts, or what we call as the exemptions, are currently $12,920,000 per person in 2023, double that for a married couple. So without further congressional action, this provision of the TCJA will sunset and the exemption will revert back to an estimated about $7 million per person, double for a married couple. And this $7 million is equal to what the exemption amount would have been prior to the TCJA plus the index. So at that time, prior to 2017, it was roughly 5.4 million. If you add the indexing that we had through 2026, that gets us close to about 7 million. So the drop will go from 12 million of exposure, protection from estate tax to 7 million. So you expose yourself to more estate taxes. The second thing is that the maximum estate tax rate will remain at 40%. So if clients have an estate valued at, say, 12 million today and then died this year, their estate is under that 12.92 million exemption amount, and so would not be subject to estate tax. But if their estate is valued at 12 million or more, and let's say it was 12 million and they died in 2026 when it sunsets, after the 2017 temporary exemption expires, their loved ones would owe approximately $2 million in federal estate tax. This tax is due 9 months from the date of death.
That is a big penalty. What can individuals and couples with large estates do to prepare, Lina?
Well, there are a couple of things. Well, first, individuals whose estate value is close to that sunset amount should evaluate whether the potential growth of their estate in relation to the reduced exemption will expose them to unexpected estate taxes. So today, clients have an opportunity really to review their estate and make needed adjustments considering the possible reduction in the exemption, knowing that many people just prior to 2026 will end up being in the offices of their attorneys, and their attorneys will be very busy. So really now is the time to act. The second thing is that there are strategies that really can help. So we typically talk about marital bypass trust planning or making cash gifts or other gifts of assets to an irrevocable trust. Those are options. Clients can also consider purchasing life insurance owned by an irrevocable life insurance trust or using a family limited liability company or an FLP to make gifts at discounted values where that's appropriate in order to push more of their assets outside of their taxable estate.
Kathryn, one of the solutions that I often hear discussed is portability. What is portability and how can that help?
That's a great question, Bob. Portability is the ability for the surviving spouse to use what we call the deceased spouse unused estate and gift tax exemption. I don't know who came up with these acronyms, but they use DSUEA. So that doesn't roll off the tongue quite as well as portability. So we refer to it colloquially, and attorneys you'll hear refer to it as portability. So with portability, if someone died prior to December 31st, 2025, and they elected portability, the deceased unused exemption amount will carry over and be added to any exemption the surviving spouse could have. As a result, portability will generally allow married couples to pass a larger amount tax-free of estate or gift tax than an individual person can. Also, portability can be a relatively simple way for a married couple to do estate planning. It's simpler to manage in theory than creating marital deduction trusts, using credit shelter or AB trusts, and there's no need to transfer any assets into a revocable trust. But there are a few risks to it. Relying on portability, for example, if assets appreciate and are greater than both spouses' exemptions, that would be the exemption that's ported from the decedent and the survivor's exemption. There's an estate tax due at the survivor's death. A credit shelter trust shelters assets and the appreciation from estate tax at the first death and the survivor's death. And second, many states have their own estate tax but don't do portability. If assets are left directly to the survivor, you lose the estate tax exemption. And last but not least, a credit shelter trust does exactly what it says in the name, is it provides creditor protection for the surviving spouse, where there's no creditor protection if you just use portability.
Kathryn, those are three pretty big things to worry about. Is there anything else that people should be thinking about when they're relying on portability?
You're right, Bob. Those are some big ones, but there are just a couple more. So first, if the surviving spouse is unable to manage all of their assets, the trustee of a credit shelter trust can help manage the assets of the person who's the survivor, and portability puts the asset management directly in the survivor's hands with no professional management. If the surviving spouse remarries and the new spouse dies first, you might lose the ported exemption amount because the last spouse that you have is the ported exemption that you get. You can't collect ported exemptions if you remarry multiple times or even just once. So the ported exemption also doesn't increase with inflation, and the survivor's exemption can. Last, GST, otherwise known as generation skipping transfer tax, is not portable. So there is a potential loss of its use on the first spouse's death. So I know that's a lot of information, but as you can see, in some situations, portability may provide the best outcome for a married couple's estate planning. Depending on circumstances, it might be more beneficial to plan using the credit shelter trusts or AB trust. That's why it's important to really discuss this with an estate planning attorney.
So, Lina, this all sounds fairly technical, but I do have a detailed question to ask you. what if clients use their exemption today and then die when the exemption is reduced?
That's a great question, and many people have asked it. Because of the way the estate tax is calculated technically, there was a concern that if the client fully utilized the higher exemption prior to 2026, when the exemption was higher, the exemption was higher, the IRS would claw back if they died sometime after when the exemption was lowered, that gift or those amount of gifts that they made, and tax them as if they were made when the exemption was lower. So what this would do is produce a very unfriendly tax result, because I could have given away 12.92 million when it was that high. So I started giving money away, but then I die in 2026 or 2027 after the sunset. And now when I do my estate tax, or my estate does my estate tax on my death, that exemption amount is lower. So there's nothing to worry about, because the IRS actually issued final regulations sometime after, clarifying that to provide the higher exemption, provided that the higher exemption will apply in most situations if someone passes away after the 2025, after the sunset, when the exemption is lower. So there's no issue with that. You can make maximum gifts up to the exemption amount today. And then if you're still alive and the exemption amount goes down and you die when it's down, then they will not penalize you. And so that does not cause a problem.
Thank you. Kathryn, let's turn to the effect of the TCJA on income tax. What are the impacts of it on personal income tax?
So when the TCJA was signed, it made some significant changes to individual income tax provisions. One of the more noteworthy changes was lowering individual tax rates. Therefore, the expiration of these lower tax rates could make the income tax rate higher. Moving forward, the potential rise in income tax could adversely affect retirees who have to take RMDs from IRAs or other qualified plans, as well as cause taxation on Social Security benefits. With income taxes subject to rise, this could be a great time to look at Roth conversions. They require payment of income taxes at today's lower tax rate instead of at traditional IRA distributions, which require payment of taxes at distribution, which could be post-TCJA higher rates. Roth IRAs are never taxed again and will grow tax-free.
Lina, what about the impact of the TCJA on businesses?
Well, this is interesting, actually, Bob, because the TCJA also made some significant changes to the corporate and pass-through entity taxation. So one of the major business tax changes from the Tax Act was to reduce the corporate income tax bracket from a top rate of 35% to a flat 21%. So unlike the estate and gift tax exemption amounts and the income tax rates, this change for the corporate rates is actually permanent. But what they also did, in order to have some equity between corporate businesses and pass-through businesses, is the TCJA made changes in how pass-through entities are to be taxed. So the new 20% Section 199A qualified business income deduction allowed many pass-through entity owners, like owners of FLPs, LLCs, S corporations, for example, to reduce their business income tax by up to 20%. And it's a complicated formula, but for the most part, this was welcomed by a lot of the pass-through companies. This change, however, is set to expire after December 2025, resulting in all pass-through income to be taxed at the personal income tax rate of the business owner. So there is going to be an interesting situation occur where the corporate businesses that have a corporate tax rate and are C corporations will continue to benefit from the flat 21% tax rate. Their rate won't go back up to 35%, but the pass-through entities, FLPs, LLCs, S corporations, will end up losing their 20% deduction. And so this is not going to make people who own those types of businesses very happy.
I want to ask each of you what strategies our listeners should be considering given this sunset that will occur at the end of 2025. Kathryn, I'll start with you.
Sure, that would be great. There are a few strategies to consider that come to mind. First being make sizable gifts before the sunset. This can enable the ILET to pay future life insurance premiums and the individual to not have to make any more gifts post TCJA sunset. So what you would do is you would pre-fund an ILET or an irrevocable life insurance trust to pay future life insurance premiums with large current gifts. This enables the trust to pay premiums without relying on any future gifts from the insured grantor and without concern for any potential future legislated restrictions giving capacity. So no matter what happens with the gift tax or with taxes moving forward, that money to fund the life insurance sitting inside the trust has already been completely gifted now, and we don't have to worry about it again. So it's basically the idea of set it and forget it.
Yeah, I'll add that another strategy, in addition to that very important one that Kathryn just brought up, is making gifts of income producing property to irrevocable life insurance trusts to pay future life insurance premiums. So in 2026, the federal gift, estate, and generation skipping transfer tax exemption, as we mentioned, is currently 12.92 million per individual, and double that per couple, will change significantly, reverting back to about 7 million per individual indexed for inflation. Current gifts of income producing properties, say, apartment buildings that generate rental income, for example, or any type of, commercial real estate or other types of funds that or assets that produce income, can enable an irrevocable life insurance trust to pay future premiums without relying on future gifts made from the insured grantor. So it's great to move that income producing asset into the trust now, soak up some of that exemption that's available before it expires, and then have the trust use the income generated from that asset to fund the life insurance without worry that you have to continue making gifts in the future. And high net worth clients should really consider giving sooner rather than later in order to use the gift exemption before it disappears to soak up that amount. So I would say cash gifts as well as income producing gifts are good strategies.
Kathryn, anything else you can think of?
Sure. One more thing, and that would be discounted gifts. So you have the ability to use discounted gifts to enable an ILET to pay future life insurance premiums. So sometimes when you own a portion of a business or real estate or another hard asset, if you own a small or a minority interest, you can make what's called a discounted gift. And in 2026, the federal gift and estate tax, currently 12.92, we know is going to change. We've been talking about that, and reverts to $5 million per individual, which we think will end up at 7. So if we have an asset that's worth, if I owned 100% and it was worth 10 million, if I give away 20%, I have lack of marketability and potential lack of control because I can't make decisions as a 20% owner. So I could therefore work with an accountant and tax advisor and take a deduction on that, or take a discount on that gift and gift that interest to the ILET and use that income producing property interest to then pay premiums moving forward. And that's just another way to utilize the current lifetime exemption of 12.92 before we potentially lose it in the next few years.
Well, the expiration of the TCJA will substantially impact retirement, financial, and estate plans for many individuals. Today is a good time for clients to consult with their financial professional, tax advisor, and legal advisor to ensure their plans reflect the potential changes on the horizon. It takes time to implement strategies, so call them today. Lina and Kathryn, is there anything else you'd like to add?
I think it's the use it or lose it proposition. Either soak up some of that exemption and use it today, or you're going to end up losing it.
I would agree with you 100%, Lina. And I would also say what you had said in the beginning, I will echo that because it's so important, which is do something now. If you wait until December 2025, attorneys are going to be slammed with business because most people are going to wait and see. We want to see you guys prepare your clients and even yourselves in advance so you're not stuck without being able to get an attorney as this date gets closer and closer.
Well, we will include a link to learn more about MassMutual's whole life insurance offerings in the notes that accompany this podcast. Thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, today featuring Lina Storm and Kathryn Wakefield of MassMutual. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.